So this is sort of why we're all here for this particular item, is what we're actually assuming. So these are the long-term rates of return. You'll see these in attachment 2, and we'll sort of go into that, the attachment itself in a moment. But I wanted to just point out kind of a couple of things here. One is, we talk about the sort of color coding is aligned with these strategic classes. The highest rates of return that we expect are in our economic growth bucket, consistent with what we've talked about. And then within that bucket, we expect to earn higher return from private equity, in this case 1.5% over the long term. And then down at the bottom, sort of this diversifying bucket in orange, with our real assets in the middle. And this is sort of the conceptual idea of where, as you go from the bottom to the top on this, the rates of return are going up, the levels of risk are going up, and this is sort of how we expect to earn our long-term returns. And if you bring that together into these strategic classes, it brings, I think, even more clarity to the idea where these ranges that you see on the right for the strategic classes reflect kind of reasonable weights of the underlying asset classes. So we're trying to kind of simplify the picture from all the asset classes, the 7 classes you see on the left, to something really back to the core function of what each of these areas is. And you can sort of see these 7.9 to 8.2, that's a reflective of kind of what we think are reasonable ranges for public and private equity weights over time. And we do the same thing for the other 2 buckets as well. And all sort of in the spirit of trying to provide reasonable assumptions and sort of bring some clarity to it. So one of the things we touched on in the memo a little bit, and sort of is relevant to talking about reasonable weights, is particularly in the private markets, we have capacity constraints at a certain point where beyond a certain size in an asset class, we have less confidence in our ability to actually earn the high rates of return that we expect, and just overall sort of practical implementation constraints in the short term. So we want to reflect that fact in how we actually do the modeling. So as a simple example, our current portfolio, if you were to take our current targets, we have these strategic weight targets on the left of 60% in economic growth, 17 in real assets, 23 in diversifying. When we actually go to model these portfolios over time, we want to try to accommodate sort of a reasonable path to get to whatever the long-term target is. So this particular example is just using our current allocation, but to the extent you wanted different target weights for a private asset class, we're going to build kind of a reasonable path to that weight into the modeling. So everything you see in July and September, November, we're going to build that path into the liability metrics, risk and return. And so this, you can see with our current targets, we have economic growth is 60%, and we have 51% target to public and 9% to private equity. So built into the modeling, if we were going to model the current portfolio, we'll basically increase private equity 1% a year. So you can see as you go from the current to year 1 to year 2, private equity is increasing to its target. So the modeling you'll see will reflect those weights. As private equity goes up, public equity goes down, and the sort of important piece is that overall, the economic growth bucket stays the same. And we'll do this similar exercise for real assets where it's relevant, and same thing with diversifying, all sort of with the idea of trying to make the modeling as sort of reasonable and practical as possible. So when you're looking at these metrics, you don't have to wonder whether, if you're allocating a higher allocation, say to private equity or real estate or some other, or inflation sensitive, we sort of built this path into the modeling. So we have the assumptions that we're actually we'll be asking you to adopt in attachment 2. We have the details both at the asset class level and the strategic class level, all of the underlying assumptions. We thought, figured you would want to hear from Makita, and thought, before Geraldine sort of wraps it up, we'd, answer any questions and then hear from Makita as well.
Okay, so why don't we do that? Geraldine, and then we're going to go to Makita, and if you could reference in particular your memo, there are some key words and terminology that you use, I think that is reassuring for us. Geraldine,
Yeah. Actually, I'm going to hand it over to
Sure.
Steve and Alan to basically opine. Our recommendation is attachment 2. Again, we worked very diligently, as Josh pointed out. We feel confident in these numbers as much as you can be, given the variability. So we wanted them to opine. We're looking for approval so we can move to the next step.
Steve and then Alan, and then we'll open up to questions or comments from the committee.
Great. Maybe I'll go first, and then Alan, I'm sure we'll have some comments as well. Our memo is on page I&V 152, and there's a 2-page memorandum and then an attachment, which I'll speak to as well. What I want to make sure I communicate clearly is that Makita was involved in the process of setting these recommended assumptions with staff over the last several months, and we concur with the recommendations from staff. Josh sort of hinted at the degree of kind of thought the industry puts into these assumptions, and our perspective is the amount of thought and work that staff puts into their modeling is a best-in-class effort in this arena. They use appropriately Makita as your consultant to provide guidance along the way. But I also want to highlight that they do their independent modeling as well, which isn't always the case with pension plans. So I think what you're getting here is lots of independent eyes looking at these figures and coming up with conclusions that all parties feel are reasonable. For me, the most important part of capital market assumptions is not the absolute numbers themselves, but that there's internal consistency with the numbers, and that your expected return of private equity or public equity, as I'll get to in a moment, can vary significantly depending on underlying assumptions that you make. But the amount of excess return you get from increasing the risk in the portfolio, moving from bonds to stocks to private equity, should be consistent, and yours is. So these capital market assumptions reflect the fact that higher risk asset classes have higher levels of expected return. I'll also note that part of these assumptions are assumptions of volatilities and correlations across the asset classes, which are a quantitative measure of the diversification benefit of investing across asset classes. Those we feel are also, the process for developing them was very strong, and the outcome was one that we concur with. We attached to our memo, just for reference as well, a study that a industry actuary puts out every year, which we find very helpful in communicating to our clients, because the one thing that we would highlight to you is our numbers that Makita comes up with are very reasonable, but we'd be the first to say that, maybe I'll be the third person to say it today, predicting, well, what did Yogi Berra say? Predicting is difficult, particularly when it's about the future. So we know that our assumptions are going to be precisely right over the next 20 years. But I do think it's somewhat comforting to know that a wide variety of independent groups look at long-term return assumptions and come up with expectations that fall within a reasonable range. And what I would highlight from this is that your assumptions for this year's asset allocation modeling process are within industry norms of where capital market assumptions are, not just within the range of reasonability for Makita and your staff. So I'll close out my comments there and hand it over to Alan for any comments he might have.
I think Steve and the staff have really addressed it pretty well, but I just want to bring a couple of issues to your attention. It is going to be an asset liability study. We're primarily here talking about the asset side. The key is how the assets fit with the liabilities, because you're in business of paying benefits. In fact, if you were fully funded, we would urge you to get out of the investment business and just be in the benefit business. Sadly, you're not there. But it's important always to keep that in mind. The liability side, there's a great degree of certainty about what the liability is going to cost you 20, 30, even 40 years out. It's a lot of math that goes in there, and it is called actuarial science. No one's ever called people in our business, the investment business, scientists, because
Or Scientologists.
no, don't go there, Mr. Chairman.
Well, you may be.
No, we're not going to discuss.
No.
We're not going to discuss religion. I have enough other issues that I have to be challenged with. But the one thing I can guarantee you, with the numbers that are presented, which I support completely and are reasonable, they will not be what happens.
Right.
And it's just very important that we and you are humble in the adoption of these numbers, recognizing that you're going to be revisiting this process in 3 or 4 years to reflect new information. And it's a dynamic process and not a static process. And very, very important to keep that in mind. The other thing is the goal of this process from an investment perspective is to be diversified. By definition, that means that there should be a part of your portfolio that always stinks. Okay, there should be something that's not working, because what went wrong in 2008 and 9 was there was not a recognition that everything was highly correlated. And you ended up getting a very negative surprise because you were not truly diversified. And we, working with your staff and working with you, are going to truly try to make sure that the portfolio is well diversified as part of this process, and adopting these sorts of assumptions are part of that process.
Thanks, Alan.
If I can, I just want to follow on what Alan's saying, because the next slide shows you, we are going to show you, once you approve this, we will come back with portfolios that are addressing the liability side. You know, are we going to meet the funding plan? What's the chances of a very low funded rate? And what does it mean to contributions? So rest assured, we will bring in the L side in July, and the actuaries will be highly involved in those numbers.
So I'm going to turn it over to my colleagues in a moment. So what we're being asked to do today is adopt the capital market assumptions which are being presented to us today, which are reasonable within the industry. And then the next step in our asset liability study is Josh and the team is going to come back with different types of portfolios and what the trade-offs would be for us in different scenarios, and what that the impact it would be on long-term returns and the risks, right?
Correct.
Okay, great. So Betty, and then we'll go to Bill.
Eric, can I just add, when you make your motion, what we need you to adopt is INV 148 and 149.
Thanks.
So
Chris.
together that's attachment 2, but to make sure everybody in the public.
Thank you. 148 and 149. Betty?
Thanks, Harry. Really appreciate the presentation. I'm trying to reconcile, I guess, my experience over with our sister fund that looks at a 30-year term that is developed in part by incorporating kind of a shorter term 10-year forecast and in anticipation of a downturn. And this may all be moot, and that's really about a point in time. But and I have confidence with respect to the survey that you've done that we're within industry standards. But I guess the practice of looking at kind of a more short-term forecast, is that something that you do internally? 5 years, 10 years?
So as part of our assumptions, we don't break it out in what we present here, but that it does involve looking at a shorter term forecast, so 10 years, and then sort of blending that with long-term historical averages, and that's pretty consistent across most of the asset class assumptions.
Okay, because if I were to look at this 20-year term that you've just described, seems to me that you know, kind of nearing the end of an economic cycle, that the projected returns seem a little high. And so just trying to kind of have the right context around how to look at that.
I think Alan was going to say something. I would just say, I agree, and I think what we try to do is that's part of the reason why we build in a shorter-term forecast into the long-term, and we blend it together. The challenge we face in sort of building these assumptions for the long horizon is, while we have a lot of uncertainty in the long horizon forecast, we have even more in sort of the shorter the forecast, there's even more uncertainty. And so we try to strike that balance between, you know, a reasonable short-term forecast and recognize the uncertainty that's involved in that.
And then in the survey of capital market assumptions, is that a practice that's generally incorporated in terms of, okay, good, thank you.
Bill?
I was amused, Alan, by your comment about not being a scientist, and I was going to ask, the actuaries, I've always thought of as an actuary sort of driving down the road, looking in the rearview mirror, trying to figure out where he's going, and, you know, the old adage. The
For David's reaction.
Were you involved, was your group involved 4 or 5 years ago in the last capital markets assumptions?
Wearing a slightly different hat, but the answer is unequivocally yes.
And were those accurate within reason? I mean,
The results are well within the range that we believed would occur. But I can show you a period from 2000 to 2010 where the assumptions we used at the beginning of 2000 had nothing to do with what happened in the following decade. Because you had 2 100-year events on the downside, and it didn't come out of that until the end of that period.
so I take it that those experiences are also part of your analysis in the future.
Without getting everyone confused, including myself, the modeling process is designed and intended not just to look at average returns, but to look at what happens in unlikely events. And so you will see what happens in a 1 in 10 or a 1 in 50 negative and positive event, because in fact, you need to plan for that, or at least consider
Right.
that as part of your decision-making process.
Thank you.
Thanks, Bill. Seeing no one else in the queue,
I was ready to make a motion.
yeah, go right ahead, Chair.
I would make a motion to move staff approval.
Okay, so his motion is to adopt the,
Adopt the capital market assumptions on INV 148 and INV 149.
thank you, Sharon.
Second.
It's been moved and properly seconded to approve the capital market assumptions as presented on INV 148 and 149. Seeing no one in the queue to speak to that, I'll continue the dialogue. All those in favor say aye.
Aye.
Those opposed? Thank you. The capital, an abstention right here. Capital market assumptions have been adopted.
Thank you.
Look forward to the next step in the process. Thanks. Thank you. Why don't we take a short break, 10-minute break? We'll come back at 3:30. All right, 3:30? For those that are going to client advisory, Grant Boykin has informed me client advisory will be at 4 p.m. today, not at 3:45. So make that a note to yourselves. Thank you. Chris, CIO report.
Thank you, Harry. I just want to point out, Pat Geyer and, there you are, waving your hand. Loretta Trottenberger has got her ears in. Okay, we can start.
Yes.
Much as we think we run this place, I know who runs this place.
VIPs here.
So, overall asset allocation. I updated this slide just a couple days ago, and I think it's updated on your website. Total fund was $233.7 billion at the end of April, which was an all-time high. Unfortunately, we did not stay there immediately right after that. Not only do we have the outflow of contributions, but Pat, I would definitely say in your newsletter, we're at $230 billion. That's a safe number to always tell people. And as you can see by that chart, been an up and down year, but not a lot of gain overall. Here's our asset allocation. And I really want to drive the point home that we are really 100% aggressively neutral. We are pretty much sitting right on our targets. We don't have a strong house view, and we'll get into that discussion in the tactical asset allocation discussion in closed session led by Scott and the team. But we are really close to our targets, our interim targets within our asset allocation. And this last week really probably represents that, where the market hit a new high, but then trailed off. So here's our fiscal year to date. And that line really shows you where we started the year at June 30. So we had a really tough part to the middle of the year. That December sell-off, as I emphasized, was very traumatic, particularly that Christmas Eve crazy experience. We have rallied up. Now, if I updated this chart, obviously we've come down a little bit, but we are still up on the fiscal year to date. At one point, I think, let's see, yeah, the market was up around 7% fiscal year to date as of yesterday. And I want to introduce you to, believe it or not, this is a longer view back to March 9 of 09. So I want to introduce you to what's now the longest running bull market in U.S. history. What I would really emphasize is at the far end of that chart, notice how choppy that top feels right now. Not a lot of, yes, we hit a new high in August. We hit another new high here just at the end of April, but not a lot higher than we were in January of 2018. So we've had flat periods in the past. Look at that 2015 period where people thought the bull market was over. We traded down and kind of went sideways for almost a whole year and a half, but then the rally started again. So it is still considered a bull market. That is rare. It is very long in the tooth. I've always told you bull markets don't die of old age, but they do get tired. And I think we're in a stumbling phase within this bull market. Here's the non-US market, and it's a different picture than the USA in fiscal year to date. And as you can see here, it basically shows it break even. Technically, as of the other day, we're about -1% fiscal year to date. So we're seeing that diversion between the USA and non-US, where the US is up about 7%, non-US is flat to negative. And obviously that's being dominated by Brexit. The questions about the German economy, France, and then just the lackluster economy that we've continued to see out of Japan. So a pretty tough time within that overall equity portfolio. I told you last meeting I really wanted to emphasize a lot the yield curve and keep us focused on that. We talked about inverted yield curves, that really is between 1 year and 30 or 2 years and 30. Not just part of the curve. So that bold green line is where the curve was last week in April. And you can see it's still positively sloped, but barely, only about 52 basis points. And in fact, the first half of the curve from 1 year out to about 7 years is slightly negative. That doesn't signal an inversion. So it's not something that we get excited about. And oh, by the way, even if it showed an inversion, again, that's where the front end has a higher yield than the long end. It only has signaled a recession within the next 15 to 18 months. So it's not going to happen overnight. One of the things I do for you is try and climb up into the crow's nest and look out onto the horizon. I think obviously, I did create this slide a week and a half ago before last weekend, but the number one thing on my mind was trade fights, trade wars. Obviously, that links into the one that's third from the bottom is President tweets, because who knew those would come together. But even today, the market was up about 100 most of the day and then went right to zero, again, because of concern about China and this trade talk breaking down. There's more volatility in the trade talks, I think, than the U.S. is used to. And that's in part because we have a very unique, obviously, White House than we've had before. It's more real estate kind of negotiation, which is pretty rough and tumble, Mike will tell you. The other things I would say that aren't in the headlines, but we're very worried about are any kind of Federal Reserve surprise. People are very, very focused on any word that Jay Powell uses. And even yesterday, when he had his vice chair out talking, people were glued to every word that was said. We're also very concerned about the ECB and any central bank surprise around the world. Brexit, by the way, hasn't gone away. It is still out there. And that, I think, is going to lead us to some volatility. On the positive side of the scale, economy is growing around 3%. We'll see if last quarter's number gets revised lower. Sure seemed a bit hot for a year where we had, a cyclone bomb and obscure weather. But employment, if you remember, I've told you we're really going to watch employment numbers. The employment claims number that the economist in January, we had two of our economists come and talk to us as part of the Investment Insight. Both said that you should watch the 4-week average on unemployment claims. So I'll continue to try and send that out to you. But that is surprisingly at 50-year lows. It's back to levels that we didn't see until the 1970s, which just seems crazy. Inflation is in check. In fact, the Federal Reserve is worried that inflation is too low. I'm always worried it will get too high, and they're definitely on hold. There's another category for the new board members we talk about, which are inevitable surprises. So those are surprises that we all know are going to happen, but they will shock us when it does. And so the worst one I can always pick on, knock on wood, is the San Andreas Fault having a big shake. We know it's going to happen. We know it's overdue, but when it does happen, it still will come as a complete surprise. So here are some of the inevitable surprises, and you've asked me historically to put this out there so that you're thinking about these. Clearly stronger, more violent storms. I just heard coming in today that Houston's having another rain event and severe flooding. You probably saw the pictures of a dust storm enveloping an Australian town. So much more climate extremes. The other one that I still think is a big concern, given the conferences I've been to and some of the comments we heard at the Milken Institute, is internet disruptions and cyber attacks. I think we've been very fortunate in that area, probably due to the work the government's done to protect cyber sites and those things, but that is a huge risk, continues to be a risk. And then the last one I'll hit on is the pandemic. We haven't talked a lot about, flu season's ebbed and moved away. We haven't talked about it, but there is a growing issue of swine flu in China that may severely impact pork and pork prices around the world. Yep. And that's an issue that's been presented to us several times about factory farming. For any of us that, I have to do the I-5 drive pretty regularly because my in-laws live in Southern California, and you go by Harris Ranch and you just see the mile of packed in cattle. That's going to be a challenge, I think, is the risk of disease spreading. You guys have probably heard the statistics that I think it's about 80% of the antibiotics in our system or that are used in protein, like cattle and pigs and chickens. So anyway, I just want to plant that out there as a risk that might be on the horizon. Within the risk report that's in your pages, the one thing I want to highlight, page INV 159, shows you the list of country exposures. USA by far at 75%. We talked a little bit earlier in the morning about China. China remains only our 7th largest country exposure at 1.2. But William, that's where we really said as a group, we need to debate that. Should it be larger? It's the 2nd largest economy in the world. What position should that play in our portfolio? And our index vendors are adding it in over time, particularly in 2018. So it will be part of the constant discussion for you as a board. What should we do? Do we, especially when it comes to, as I've always said, the ESG factors and the system in China. And then lastly, on INV 163, I want to highlight we do have a fund liquidity report. We don't focus in on it a lot, but Josh added that in, Josh Diedisch and his risk team, which really shows you the liquidity we have to pay benefit payments. And obviously the tier 1 assets are immediately liquid, which means we have over 10 years benefit payments available to us. So I always want to highlight to people, we're still a very liquid plan, even though we have a negative cash flow. Well, that'll open it to questions.
Thank you, Chris. Oh, Dana, log back in, please.
Sure.
Thanks. Okay, Dana and then Sharon.
So Chris, I know in the past when we've talked about the unemployment numbers and how low that is, we talked about those people that are no longer even seeking work. Should we pair those better when we have that conversation about low unemployment?
If you remember, Rosie, Lucasini Jack came up last time and talked about there are, I think, 7 or 8 different levels of employment statistics, and I think she said it's U7, I might have it wrong. We can break those out because we can show you the number of people that are in jobs but want a different job, or working part-time but want full-time. We can get you those kinds of statistics. The Labor Department generates those kinds of surveys. So weekly jobless claims is just the number of new unemployment jobless claim being filed by a person. And remember, the Department of Labor says that if you're unemployed and you're not actively looking for work, they don't consider you unemployed. They consider you sort of retired. So there's always challenges on how they manage those statistics. And I would say, sadly, in my entire career, they have constantly been thinning out government statisticians, the fewer and fewer. Not to say that we don't have confidence in them, but they're not, they get a lot of corrections and revisions. So that headline number moves the market, but you really got to pay attention to the revisions to the past periods. That's why we look at the 4-week moving
the
average.
market's really paying attention to what it is you're telling us, so maybe we don't need to.
No, I think they are, but I think it would be helpful for you, because we've had that question before. It would be helpful for you to look at the underlying stats. But yes, the market is focused on that 4-week moving average.
Okay.
And just its overall direction.
Alrighty, thank you.
Sharon?
Chris, I was just curious, because when I hear all the talk, the trade talk with China and how it's hitting farmers in the Midwest, and I mean, the interviews I hear are mostly with Midwest farmers and how it's hitting that area, and I just how much does that impact? I mean, ag is such a huge part of our economy in California, and I mean, is that, and given our economy is fifth largest economy, or
Number 1.
and I wondered if you could just, I mean, I don't know, I know you don't have any answers, but how much does the trade talks with China, how much does that impact kind of our agricultural, sort of our trade basically in California?
Well, and I went to this slide probably for the teachers in the back of the room, but I'd also encourage you, it shows up in 2 places. INV 163, and then probably more useful for everybody is INV 158. Global GDP growth is basically about 75% of our portfolio's risk. So we are really linked to global GDP. The U.S. is the biggest slice of that for us by far. So how the U.S. goes, so goes our fund. And with these trade wars and the tantrums going back and forth, if they put in tariffs and they built up serious barriers, it would have a dramatic impact on our portfolio. Our country can have, basically, you can have weakness in the Midwest with low soybean prices and farmers hurt. Obviously, the auto manufacturers aren't doing well, but then the 2 coasts are doing very well. And I remember in our career, Alan will remember, we at one point had a bi-coastal recession where the 2 edges of the country were in recession, but the middle was doing quite well. It really does matter about the aggregate. And as I showed you in, I think, a slide last meeting, China is our biggest trade partner. So getting this done and effective is critical.
When you say our, California, or?
No,
US?
USA.
Okay.
I don't know that we have stats broken down to the individual state of California. I bet Mexico is our number 1 trading partner.
Okay.
And then Canada, and then it would be Asia. But it does matter, but it is right now negotiating noise. What matters is that they get something done and find some reasonable balance. The fear has always been trade barriers lead to, those tariffs lead to trade barriers. Trade barriers in history when they get really bad, have led to recessions or depressions. So that's why it's a third rail issue. What, you were gonna say something, Alan? Hit the mic.
Sadly, it goes to war. I mean, the reality is you've had heightened tensions in the South China Sea, and both Russia and China massively increasing their military. People don't do that for illegal-mercenary purposes. So it's just important to remember that there are risks out there that we don't think about every day, that Chris is trying to put into his thinking. But just looking at things like the employment number, it's just one part of a very, very complex mosaic. And I don't think you can put too much emphasis on that one number, particularly since averages don't tell the whole story.
Right. Thank you, Alex.
Thank you, Chris. Sharon, anything else?
Yep, I'm good.
Okay. Dana, I have you next. Are you,
Nope, I think I
Okay.
just didn't get out of one.
all right? Is no one else in the queue? Thank you, Chris. Item 9 is also an information request. This is a continuation of our conversation around the CalSTRS collaborative model. And Scott Chen,
Fact sheet that was given to us.
And crew.
Scott, we have about 20 minutes allotted for this, so keep that in mind during your presentation. Sounds good. Good, thank you.
And as they all come up and sit down, for the board's sake, it's pretty obvious, but I want to state it right here. I'm hogging it. As we have embraced this idea of a collaborative model, and Scott has come on board, it fits his experience and I think his knowledge base. So I have asked Scott to really be the lead point person as it comes to the collaborative model. You'll see me to refer to him on and defer to him on almost all of this and really take the lead on it. So with that, Scott?
Scott, are you going to go through
Drive the train.
PowerPoint? You have a
Yes.
PowerPoint, right?
Got it, yeah, thank you. So my name is Scott Chan, I'm the Deputy Chief Investment Officer. My role is to help lead the investment team. I'm joined with two of my directors, Mike DeRay, the Director of Real Estate, and Paul Shantic, the Director of Inflation Sensitive. So today I want to cover three topics with the CalSTRS collaborative model. I want to tell you CalSTRS story. It's the story of our implementation. I want to communicate the vision. It's the board's vision, it's staff's vision, and it's become the organization's vision. And to that latter point, I want to lay the foundation for a unified approach across the organization, focusing on 4 pillars of resources. So I think that you got a 2-page handout that talks about the collaborative model, and that's just it's a summary that it actually originated from Jack. It was a great idea. We were at a ledge hearing, and he thought this would be a great way to summarize the last 2 years of study. So it's something that you can take back with you. But just to kick off with a 2-sentence definition, you know that the CalSTRS collaborative model is our internal approach to manage more and more of our assets internally so that we can save costs, we can save on fees, we can control our risk, and we can develop return opportunities. In a nutshell, we accomplish that in 2 ways. The first way, as you can imagine, we build our own internal teams. We build all of that infrastructure and we manage it internally. We do that in global equities. We do that in fixed income. The other way is by partnering, because it's not strategic always for us to build that internal team. So we partner for returns. We partner with our peers, such as APG. We partner with our investment managers, and we partner internally. That means that we've broadened the definition of what we consider internal management to include things like joint ventures with our peers, to include things like separately managed accounts, to include things like ownership in real estate operating investment companies that we'll talk about, as well as building our own teams and managing it internally. I want to say there's a lot at stake. Obviously, we have a proven track record of being able to execute and save hundreds of millions of dollars. So there's a lot at stake. And I always like to start off with the framework, the governance framework. And you can see here in the boxes, in the blue, those are board decisions, and in the red, they're staff-driven decisions. So I'd like to start in the middle of the blue box is the strategic asset allocation, which we discussed in the ALM study. That's obviously you've heard, the single most important decision. 90% of the risk and return attribution will be attributed to that. Then you delegate to staff that implementation, right? And you not only delegate to the staff, but you ask us to exceed that, and the target is 40 basis points. The CalSTRS collaborative model is the most significant form of our execution to achieve that target. So it's imperative that we succeed. I also want to say, even though you've delegated that implementation to staff, the board really owns this vision as well and has influenced it. You can see in the strategic asset allocation, in the strategic plan, in the work and business plans, as well as the investment beliefs. So I just want to start with the investment beliefs. You can see that the CalSTRS collaborative model touches on 3 of them. And as a reminder, the investment beliefs were created by the board. They provide the foundation for staff to invest in a manner that's consistent with the board's vision for us to accomplish our fiduciary goals, to fund our liabilities. And the CalSTRS collaborative model builds on internal management capabilities to save costs, reduce the fees, control risks that we discussed, so beliefs 3 and 4, as well as belief 8. It increases the alignment that we have with our partners and our financial interests, because we end up having partial or full ownership of investment management companies, which is more complete alignment. We share in their economics, and they're investing alongside us in these businesses. The next 2 slides really talk about and highlight the mission of the CalSTRS collaborative model. And you can see that over 30 years, we've generated about 8.6% return. 8.3% of that was the strategic asset allocation and the policy benchmark. 0.3 of that was the excess value that we added above the policy benchmarks. And that approximates about $600 million a year. So it's that 0.3%. So it's very significant if we outperform by that amount. Harry, were you going to say something?
It's bothered me since I've been reading that slide several times. Do you see the second bullet says 20 years? Is it supposed to read 30 years?
I caught that same thing, and it bothered me. So good eye.
Okay.
It's really a 30-year statement.
All right, thank you.
So,
and the outperformance is how much per annual?
It's 0.3% per year, which in today's dollars, if we did that, would translate into about $600 million above our policy benchmarks. So very, very meaningful. And I just want to highlight in this slide that we have a meaningful, measurable track record of success to build on. And in many cases, we're talking about going progressively one step further, or in many cases, doing the exact same thing, but doing more of the same. The next slide, a lot of our success in our outperformance, one of the most significant drivers has been cost savings. So this slide breaks out the cost for external management, what we pay our external managers to manage assets on our behalf, versus internally. And you can see there's a stark contrast. 56% of our portfolio in the year 2017 was managed by external managers. That cost us $1.8 billion in fees and incentive fees. We manage 44% of those assets internally, and that cost us $30 million. So you can see that one of the most significant opportunities for us as an organization is to use our competitive advantages and our size and scale to bring more of those assets internally. And that's what the mission of the collaborative model.
A question, Bill?
On that slide before the last one, where you outperformed by 30 basis points, was that net of fees?
Yes.
Okay.
This is all net of fees. So I was recently at the Milken Conference. There were 6,000 people. And you can tell that Harry is a connector because I saw him several times out of the 6,000 crowd of people. You already know.
Mr. Chair.
He dropped a quote on me that I really love, and the quote was, "Make time your friend." It came from a famous investor in China. I actually used to do business with him. His name is Zhang Li, and he founded Hill House. But he was giving a graduation speech for the Renmin University, and I'll just quote him here. He said, in his work as an investor, my experience is that you use a long-term horizon to consider questions and make decisions. Time will naturally become your friend. And I think when I look at this chart, this evolution of CalSTRS, I can say that CalSTRS has befriended time. Because if you look back at the 30 years of when we started, in 1987, starting to internalize management, we've built 30 years of competitive advantage. We have world-class partners that are long-lasting. We've built staff. We've created that expertise and the infrastructure. And so, and most importantly, I think that, as you know, life isn't created in a straight line. We spent 30 years of lessons learned in this endeavor. So I think it's, CalSTRS has befriended time. I want to also just mention that we've identified strategies, as you can see in this chart, since 1987 to internalize, but we've gone through a period of significant growth in both our asset base and complexity. You can see that in 1980, our portfolio was actually managed by CalPERS until we split off. And then in 1987, we started managing assets internally. And now we manage 45% of our assets internally. We've gone from no employees to 182. We've increased our private markets investments, which are a little bit more on the complex side, from 9% in the year 2000 to 34% in 2018. We're global, and I think what it says is that we have been very progressive in this evolution. We've been very disciplined, and we've moved on today. Where 30 years from now, you can't recreate what's been done and the history here. The other thing I want to draw attention to is that you can notice that there are a lot of firsts on this chart, and those firsts are actually a long time ago. So I'm just going to call out a few of them. In private equity, we made our first investment in 1988. That's pretty early in the private equity industry. We made our first co-investment in 1996. Now 7.5% of our portfolio is co-investing with the goal to move to 15%. Real estate, we made our first separately managed account investment in 1987, and in 2002 formed our first joint venture. 2007 purchased our first real estate operating company to own, and now 80% of our real estate assets we control, which is amazing. I'm going to save talking about the public markets in another slide, but I'll just end by saying I'm proud of the history. I think you should be too. It's been a very disciplined, progressive approach. It's been an evolution where we've befriended time. It's not been a revolution. I think that this really is the story of CalSTRS implementation, and I think that we're in a fantastic position because of all of these things to continue to move forward.
So the next couple slides, we're just going to go through some examples of both the public markets and the private markets. And the board item actually gives you a chance to go back and look at some of over the last 6 board meetings. We've reviewed the private market asset classes and some public market gains. But with respect to this slide, what we show on the blue bar above the chevrons is what the opportunities are both in public and private investing. And the highlight in the public markets is they're on the far end of it in internal management. Obviously, the public markets are a lot more efficient with respect to the markets themselves, and we were early movers in that space, and you may have a couple of comments.
Yeah, just a few comments. We started studying this a few years ago. We focused on the private markets, but you can see that this implementation is across all of our asset classes. And in public equity and fixed income, you can think of the analogy, we actually own our own internal money management firms and all the infrastructure to execute that. This is the statistic you usually see because we've developed measurements for our public markets to say how much we manage internally and the cost benefit. And so this is the statistic you usually hear. You know, as we've invested $1 in an investment professional here, we've reaped about $10 of benefit, primarily form of cost savings. That's a pretty good return on investment. Typically, we would think of 3x as a good investment. So it's been a fantastic start for us. I do want to call out that in fixed income, over 30 years ago, we started to begin to invest directly. High yield began in 2011, currency management in 1995. Now 85% of our assets in fixed income are managed internally. And how did we do? They generated 89 basis points above the benchmark over the last 10 years and 23 basis points over since 1982. So they've done a fantastic job. Global equities started internal management with the most straight.
That was Glenn Hawasaka at Fixed
Glenn
Income, right,
Hawasaka.
for all those years, quietly sitting over there, outperforming for the last decade? And Michelle Cunningham?
Michelle Cunningham, who's enjoying
All
her
right, so
retirement
continue.
now.
I was part of it.
As a good leader. Sorry to interrupt.
And Paul as well.
And
Paul
Paul
Shantic.
Shantic and the team, yes.
Yeah.
I had to embarrass Glenn. Go ahead.
I'm glad you did. Please embarrass more of the staff. I like that.
Keep him on his toes.
Well, so in global equities, we started internal management with the most straightforward group, the U.S. large cap. We moved to small cap, then international developed and international small cap. Now we manage roughly 63% of those global assets internally. And we also have moved into smart beta, managing smart beta or risk factor approaches, some more complex areas, low carbon. And they've done an amazing job too. They are, I believe, the most efficient group. They're eking out basis points. And if you were to even compare them against other money management firms, you'd see a delta there in terms of their efficiency in order to manage these assets. As you can imagine, while we own our own internal management firms, we've had to build the operations and the infrastructure all alongside this, right? If we're trading global markets, we have to make sure people can be around in different time zones to shift and do that, so the staff could cover those areas. We've had to develop monitoring and internal controls and oversight. We've had to make sure that we can expand into sec lending and other of these areas. And so all of this, I want to say, has come together. But it's I think it's quite a feat to say that we have something akin to the likes of a BlackRock internally, or a Western Asset Management on the fixed income side, something akin to that. So I'm going to turn it over to Mike now.
Okay, so one other thing on the slide, you can see there's a cross-section of what we can work with, and both the real estate team, the private equity team, and Paul's team all works on the currency side. When we were investing overseas, we have to go to Glenn's team and they help us with our decisions on currency. So there's also that collaboration going on a regular basis. So in the private markets, I'm going to go through a few slides here, and because of the inefficiencies of the private markets, that's where the savings can come from. A few slides back, you saw the difference in the amount of fees. So also the most savings can come from working on the private markets. And a significant amount of that fee savings can certainly come from the private equity group, which talked earlier today about co-investments and whatnot. But I want to explain the slide on your right there. It's a slide we used a number of times in our presentations, and so you can look back in the presentation, that would be familiar. But if you look, what we're trying to do is lower our fees from high to low, go from left to right, while we raise the alignment of a control. And so that just means having more direct relationships, more decision-making. But as you do that, you're also, if you look at the top, you're raising the complexity of the type of investments you're doing and the decisions you're making. And so therefore, you do need more staff time and expertise of staff to make those decisions. And so what we did is we plotted some of the strategies that are in the private markets. And obviously at the far lower left-hand corner is closed-end funds. Not that that's easy to do, but with relative to what we do in the marketplace, once you invest in a closed-end fund and you make that decision, you don't have a lot of decisions to make after that. In the case of private equity, one great decision they have available to them, as they've pointed out and can do it better than I, is the opportunity to do co-investments. As they talked about earlier, I won't repeat what they said, that is a great opportunity, not just to save additional fees, but also to move, to have control of the timing of your moves and to move capital to where the best investments are over the life frame of an investment fund, which might be 5 to 7 years. Okay? So when you look at that, the co-investment strategies where it's highlighted there, those co-investments can save us a significant amount of fees, which could be over time in the neighborhoods of hundreds of millions of dollars over a 5 to 10 year period. If we move double the co-investments, as was mentioned earlier today, that could equate with good returns to savings of hundreds of millions of dollars over that time frame. Those type of things are laid out in their report that was done, I believe, as Margot said, back in November or January of this year, and you can kind of look at the detail of that. So private equity obviously can save us a lot of fees and just in the co-investment program, which is the driving force of what they want to do in the collaborative model, but they need team of people to make those decisions and move on those decisions in a short period of time. This is you, Paul.
This is me? Nice. So the inflation-sensitive group's relatively new group, as you all know, probably started out in the middle between real estate does in terms of that far right and say co-investments and individual funds. So we're sort of in the middle. And so we've had the advantage of being able to we do fund investments just as everybody else does, but we also have separately managed accounts and co-investments. And interestingly enough, something to keep in mind as we talk about this collaborative model, a major aspect of what we do by talking about this model is it generates interest from other people in the marketplace. And so we get incoming calls. So CalSTRS over time and wants to be seen as more commercial, ability to act quick, ability to make a decision, ability to put out capital. As you guys know, most pension funds, we do things very slow, methodical, and you will miss opportunities in that way. So what the collaborative model, I think it allows us to do is to move quicker, to marshal resources, to look at, in our case, a particular asset and determine whether we want that going into the portfolio or not. And as we talked about, a key part of the model is people. Not necessarily bodies in the seat, but smart bodies in the seat. People that are out there that know what's going on, that have connections across the industry. And it's always interesting to me to see portfolio managers and their connections and the people that they know. You wouldn't think they might know some of these people in accounting or some people in kind of smaller specialized parts of the market, but they'll have a connection. They might know somebody that knows somebody. And that's the stuff that gives you the information, because as you know, this is a big information game, back and forth. Who has the best information, who's done the best work, gets something done. So that's what we're trying to do on the inflation sensitive side. We've ventured with peers. You all know APG is one. We also venture with Audia, and we're involved with them as well in some renewable work. So we've sort of done those things. I'd like to say that it was like planned from the beginning, but a lot of these things just sort of came up and said, "Why?" We said, "Wow, that's interesting." Now we're at that point where the staff is probably stretched and is doing as much as it can, and so we've talked about growing the unit, and you'll see more of that from us going forward.
Well, I just want to add for the new board members, APG is the largest Dutch pension
Sorry.
plan,
Yes.
and Audia is the Abu Dhabi sovereign wealth fund.